Welcome back to our second lesson on financial documents. In our previous lesson, we discussed purchase orders, delivery notes, and invoices. Today, we'll dive into the next step in the process: receiving and recording payments. We'll explore 4 essential documents used at this stage: credit notes, statements of account, remittance advice slips, and receipts. Let's dive in. A credit note is a document issued by the seller to the buyer when money is owed back to the buyer. Reasons for issuing a credit note may include invoice errors or refunds. Credit notes help maintain accurate financial records. They typically include the seller's name and contact details, the buyer's name and contact details, the invoice number, the date of credit, the credit number, the description and quantity of goods, and the unit prices and total amount. Accuracy is crucial for credit notes as they correct invoice errors and facilitate refunds. Inaccurate credit notes can lead to incorrect payments and bookkeeping issues, which may result in erroneous tax reporting. A statement of account is a document listing transactions between a buyer and seller during a specific time frame, typically a month. It may show a zero balance or outstanding funds and serves as a payment reminder. A statement of account generally includes the seller's name and contact details, the buyer's name and contact details, the date range of the statement, the opening balance, a reference number, date, and amount for each transaction, and the remaining balance to be paid. Accuracy is essential for statements of account, as they remind customers of outstanding payments. Inaccurate statements may delay or prevent payments and cause errors in bookkeeping. A remittance advice slip is a courtesy document sent by the buyer to the seller, notifying them of an invoice payment. It helps the seller match payments to invoices, streamlining the payment process. A remittance advice slip typically includes the seller's name and contact details, the buyer's name and contact details, the invoice number, and the payment amount. Accuracy is critical for remittance advice slips, as they help match payments to invoices. Inaccuracies can lead to mistakes during this process, potentially harming the buyer-seller relationship. A receipt is a document that serves as proof of a financial transaction between the buyer and seller. It confirms payment for goods or services and is used for returns, refunds, tax reporting, and expense validation. A receipt usually contains the seller's name and contact details, the invoice or transaction number, a list of items and prices, the date of the payment, the amount paid, and any remaining balance owed. Accuracy is vital for receipts as they're used by both parties for bookkeeping purposes. Inaccurate receipts can lead to issues with financial records, tax reporting, VAT reclaims, and refund processing. In conclusion, a credit note is a document sent to customers when the seller owes money back to the customer. A statement of account is a document that lists all of the transactions between a buyer and seller during a specific period of time, typically a month. A remittance advice slip is a document that is sent from a customer to the seller to inform them that an invoice has been paid. And a receipt is a document that acts as proof of a financial transaction between the buyer and seller.